of days now in which we're seeing the oil price on Brent now firmly move above 75. So we're now officially in the 75 to $85 range. Will we be range bound? That is the question, or will we be sucked back into 65, 75? Let's kick off this morning with our regular Thursday morning commentator, Dr. Carol Nachley, Chief Executive Officer of Crystal Energy. Carol, if you were sitting in the Fed's chair ahead of the next big meeting and the markets all start to freeze in anticipation, do you look at the world glass half full, glass half empty?
Good morning, Sean. Good morning, everyone. Well, look, I mean, definitely the world continues to be glass half full, glass half empty. And I would actually describe all markets as being pretty moody, because last week we were more in a downbeat mood, and this week we are in an upbeat mood. And who knows next week what's going to be. But overall, the movements that we are seeing are still within a pretty determined range. And we haven't really broken away from that range despite the daily changes. Now, the problem with seeing these daily changes, and there are lots of optimism today in the market. You have, for example, the inflation fears in the US appear to have eased. And that's why if you were the US Federal Reserve Bank, you would have said, okay, I told you so, because it's not really, it was the higher prices were going to be transitory and not something structural, so we can wait. But at the same time, you do have the market not really being convinced of the Fed not tapering or not raising interest rates. You can still see that the market is still quite wary of any move that the Federal Reserve is going to make, and also other central banks, because we cannot only look at what the US is doing. So while the inflation has eased in the US, based on the data that we saw this week, in the UK, it had reached record high. And I think I got the number, I think since 2012. So they continue to have this kind of uneven growth. And by chasing daily movements in prices in oil markets, unfortunately, we don't get the bigger picture quite rightly. We get distracted by the small changes, by the small events, though they may have an impact on prices, but will they have a structural lasting impact on price? That should be the question that we should ask when it comes to economic outlook, which remains very uneven. China is a big thing, but we can talk about it later on. And also other developing countries where, I mean, I saw a staggering number that they would be $12 trillion poorer in 2025 than if they remained on the trajectory of pre-COVID. And these are all going to have a big impact on oil markets going forward, and also on government and central bank policies.
Is $12 trillion a lot these days? I've lost track as to what that value is. It's about 25 Bitcoins, perhaps. Ole Hansen, head of commodity strategy at Saxo Bank. Ole, is this a market? It seems with Dr. Carol talking about sort of on the demand side, glass half full or half empty, perhaps. This looks like a market on the supply uncertainty. We saw yesterday a massive draw in inventories and a big pop in prices, but hardly a surprise after a hurricane.
Absolutely not, Sean. And it is just how this oil market has been behaving all year. I think I was on a month ago or so, and back then we were quite a bit lower than where we were right now, because that was before the Hurricane Ida struck. So back then the market was focused on COVID-related demand drops. Right now we're focusing on the loss of supply especially from the US now during the past couple of weeks, adding up to probably more than 30 million barrels. And if you consider that the 400,000 barrels that OPEC Plus are adding on a monthly basis right now,
are not adding, by the way.
Or not adding, but that is another discussion we can take as well. Yeah, that's only around 10 to 12 million barrels extra a month that comes into the market. So we are market right now looking at worry about the tightening supply. Demand outlook according to the IEA and OPEC looks rosy as well into the final part of the year and early 2022, and that's all just having this change in sentiment across the market. But we're now at the high end of the range that we've been looking for a while, 65, 75. If we do break above sustainably here, then then we will see $80 eventually.
Let's bring in Andrei Belyi, professor, founder, and CEO of Basel, sitting in Estonia. Dr. Andrei, we're days away also from a Fed meeting, but also from a German election and the end of the Angela Merkel era. 16 years in power. I can't remember what it was like before that. But ultimately, Andre, what is the impact? What is the outcome of this election? What does it mean for you sitting in Central Europe on the doorstep of Moscow?
Well, it's very difficult to predict anything because we don't know basically what's going to be with the elections. Polls show that SPD, the current junior partner of the coalition government, is likely to win and likely to form a government with even more leftist party of Greens. And that definitely would have an impact on the overall European Union policy. And that might amplify all the already existing bubble in the carbon market, in the emission trading scheme, which we are observing in the European Union. Since last year, the price first doubled by the spring, and then it actually added another 30% in the summer, partly triggered by the Fit 55 proposal from Brussels, which suggests to remove free allowances for emissions for the industry. So basically, industry is under pressure and is ready to hedge itself against. And at the same time, gas markets are getting tighter, not that much tighter when you look at the physical volumes, but that basically creates a certain panic amongst the participants and also attracts traders who want to get profits out of the rising gas price. Obviously, gas price is rising, hence power companies want to switch to their coal generation. But in order to use coal, you have to pay the allowances, right? And that's basically adds again to the carbon price. So Europe is now living the dual bubble, one the carbon price and another natural gas price. And the effect of it, we don't actually know either, because it may hit quite hard, both if it overheats.
Well, I think the hitting hard part is a done deal. You're going to have massive gas prices this winter, but will you also have, and do you subscribe to the views that Amos Hochstein, the US representative for energy security, warned Europe that they were leaving themselves very vulnerable to Putin this winter? And on the question of the German election, Andre, if we get what the polls indicate, which is no clear winner, no clear leader, we've lived with the Merkel era, now we're going to have the no era. What does that do for Central Europe and the political power of balance with Putin and Russia?
Well, SPD views, let's say, if we assume that SPD wins, SPD will only amplify the current policy priorities of the current government. They will increase the same priorities. Let's not forget who is the head of the Nord Stream 1, right? Is the former leader of SPD. There are so much links between SPD and Russian establishment. So I guess actually this line of policy will only get increased. And note also that with the climate policy as being the top priority of Berlin and hence of Brussels, relations with Moscow, according to this logic, have to be improved. And that's why SPD is likely to continue and reinforce this line of thinking. Their junior partner, who are very critical, well, hypothetical junior partner, Greens, are very critical towards Russia, but I would say as a junior partner, they will fall into a trap, similar trap as French communists fell under François Mitterrand. Yeah, so when you have something to say, but that remains limited within the main line. Yeah, so we may still have unpredictable events, such as the victory actually of the Greens, or a better score for the far right AfD party. And then obviously it will create a chaos, a political turmoil.
Well, it certainly will be an interesting week, because we have the same outcome in Canada Carol, we've got Canada also caught in an uncertain outcome. The election will know how Trudeau looks to win, but very weak, very, multiple parties at the table. Two of the G7 economies looking, I think, politically more fragile. But going across to China, Carol, you mentioned it in your opening comments. What is your assessment of the China outlook at the moment? All the data points seem to be indicating that this is indeed a weakening, and it's not often we say that about China. It's not growing as fast as we thought. It's growing a little bit slower, but still growing. What's your take on China and its impact going forward?
First, I must admit that I was relieved when you directed the question about the German elections to Andre, though you got me interested in the German elections. And actually what you highlighted about Canada, there was one very interesting article in the news item that you shared this morning, Sean, is how we're moving to more a fragmentation in various countries, including here in the EU. So it's not just Germany, but France. But that actually not necessarily a bad thing. It could lead to better representation. Though irrespective of who you have in power in Germany, I think we should brace ourselves to higher taxes almost everywhere, with the UK leading the way, at least here in Europe. I don't know, the UK is not in the EU, but it's a reflection of the trend. Going to China, one thing I was surprised not to see in the news item shared today, and something which is not quite capturing a lot of attention, maybe because it's not going to have a big impact, but something definitely that we should keep an eye and follow closely, because that can spell trouble to the Chinese economy. And that is what's happening with their giant property firm, Evergrande, or whatever they call it. And it seems to be heading into administration because it's not able to pay its massive debt that it has accumulated. Now, already I saw some commentators referring to it as the Chinese or the Far East Lehman moment, but I doubt it's going to be that it will have that effect, because the Chinese government is unlikely to sit and watch such a giant collapsing with all the social repercussions that alone the economic cost. But it's a reflection of the fragility of what's going on in China. And that by itself should make us a little bit more concerned about the economic outlook for the developing world led by China, and also with spillovers on the rest of the economy. Then there is the other issue, which is the question that what's happening in China could raise in terms of what could happen elsewhere once governments start to withdraw their support to the economy. They put a lot of money to support the economy out of the COVID-19 crisis. The Chinese were the first to be hit. They were the first to open the tap, but they were also the first to try to start withdrawing their support. And that had to translate into slower growth than expected. I know that China had its own problem before the crisis, and maybe what we are seeing today is not just because of the stimulus withdrawal, but because of structural problems that were not dealt with before the pandemic. Then the pandemic masked them only to make them more visible now. Or it could also be a reflection of what we could see elsewhere in terms of the speed of economic growth. And I know on Sunday, Mike Muller and Christoph Ruhr, they kind of entered into this debate of growth. And here we have to understand that growth is a percentage, so you can still move forward, but at a decelerated rate. And that will have a big impact in terms of the economic outlook in China and elsewhere.
Ole, on that point, it doesn't seem OPEC plus have counted that in, because they, in their recent report, they maintained a 6 million barrel a day demand recovery in 2021 and 2022 above 4 million. What was your assessment of their data, their forecast?
Well, they tend to be the most optimistic of the three, naturally enough. But I think the recovery is still on track, and it really all depends on whether we're going to have another fourth or fifth wave, or we all need a third injection to ensure we don't get sick again. So there is still a lot of uncertainty, I think, related to demand next year, especially towards the pickup in traveling, which is going to be suffering for a while longer. So probably potentially a bit on the optimistic side, but at the same time, when we have these kind of outages we've seen in the US, that obviously does take barrels out of the market, which is helping to balance it. But I think, Sean, if I just may make a quick reversal to the European situation, because obviously we're stuck here right in the middle of it.
Yeah.
There's no doubt. I saw a comment the other day from one saying basically, well, they're starting to wonder whether politicians fear blackouts more than climate change, and that potentially could be a very, very hot topic as we head into the winter months if we don't see any pickup in gas supplies, because they are low at this point. As mentioned, we're not in a critical phase, but obviously if we do get another very cold winter, we may have a problem, and that could lead to companies being forced to cut demand, and we could see obviously skyrocketing electricity bills. So it was just we talked about Russia as well. It was a little bit disheartening yesterday to see the comment from Kremlin basically saying that if the Nord Stream 2 was approved, they could balance the market, the gas price in Europe fairly quickly. That obviously smells very much of geopolitics, and we have not really seen other reasons for the lack of supplies from Russia this summer. But obviously, if that is true, then obviously there is a risk. Then we potentially could have been part of a geopolitical game in order to get the Nord Stream 2 fast-tracked and approved. So it is one side we will be keeping an eye on.
Do you give? I mean, the comments that Amos Hochstein made during the week, do you think they have grounds?
It's difficult to say, because the data also from Russia does indicate that they have their own issues with filling up their own storage facilities. But at the same time, when you have a comment like that obviously smells of a lot of politics, and that obviously raised the question for the European for Europe going forward, because clearly right now in the UK, windmill production from windmills has dropped to 5% of the daily capacity. That has come down from, I think we reached highs in the 40s. That just shows how unreliable alternatives can be when we have had a hot period like we had recently where the wind doesn't blow, and it just basically means that we really have to rethink the whole energy structure in Europe. Where do we want to source our energy from? Gas is potentially a non-reliable source of supply. So
because of the geopolitics.
Exactly. So we will have to, I think there's something like nuclear, which has obviously had a revival in recent months, will be something that will be focused on in Europe or also over the coming months, especially if this high gas prices, they continue into the winter, causing problems.
Well, you would think they need to sort of hurry up with what they're going to, where they're going to bet on. I mean, ultimately, it does seem the Nord Stream 2 is like a big sort of marker in the sand that they're going with gas from Russia, which does seem. Andre, your thoughts on that? Ole is making a very important point there. The vulnerabilities that Europe finds themselves in now, and maybe we haven't even felt the big pain of the gas price coming into the winter months.
Well, I would slightly disagree with this, because the physical volumes are not very much different from what we observed last year. Yeah, they are lower, and the underground storages are like about 20% lower than last year. And then what we observe in the natural gas hubs, we see about 10% lower inflows to NBP and about 12% to TTF. So yeah, there are lower volumes, of course, but they are not critically lower. It's not like 80% lower, right? And yeah, Gazprom announced it has issues, but note what kind of issues do they have? They basically have to conduct reparatory works on the pipelines. It's not the issues with the production, yeah? So once the reparatory works on the pipelines are over, and once the Nord Stream 2 comes in, of course, there is a capacity to expand the supplies. Just what Gazprom says, look, we are on schedule to all our regular clients who get the long-term contracts. We are not obliged to supply to those who didn't conclude long-term contracts and who want to rely on spot. Yeah, there is no obligation. All the current obligations are being fulfilled. So once, and there I join Ole, once we have Nord Stream 2, we may see better flows for those who rely on spot. In addition to that, there is another hint coming from Moscow. It's exactly what I have just said. those who rely on the long-term contracts with us are secure. So it actually hint to the midstream companies in Europe to conclude new long-term contracts with Gazprom.
Well, it sounds kind of like blackmail, but
it sounds like a blackmail from, let's say, from a buyer perspective who relies on spot. But at the same time, you cannot call it a blackmail because there was an accident in Yamal pipeline, which basically a major accident, and indeed reparative works are needed. In addition to that, now with the methane strategy, you have to repair all the pipelines and replace gas actuators with electricity. So you're going to have even more of these reparatory works. Relying on spot obviously implies more risk. Yeah,
of course. I mean, there's a lot of that happening in Asia now, relying on spot, and the European market is kind of built on that. Let's just move on from that because I don't want to get too dragged down that rabbit hole, but nonetheless, a critical point, and we'll have to all be watching it. Carol, I'm interested in your views regarding OPEC Plus. We sort of half joked at the top of the discussion that OPEC Plus isn't even making the 400,000 barrel a day supply increase in August. And there is increasing question marks as to the capabilities of OPEC to meet this, to increase capacity. There's a certain narrative that, oh yeah, they've got 4 or 5 million barrels of idle supply. Do they? What do you make of their struggles to reach their own quotas?
Yeah, I mean, for OPEC Plus, it's a very diverse, colorful group, right? And we know that for long, several countries have been struggling anyway to meet production targets. Some are overproducing and others are even not able to produce to the levels because of lack of investment over many years. They did not provide the right investment framework, and they are paying the price today. But really, when you talk about spare capacity of OPEC Plus, I mean, who matters the most? For long, when it comes to OPEC, the lion's share of the spare capacity was concentrated in 3 countries: Saudi Arabia, the UAE, and Kuwait. And really, the one that has the biggest capacity to adjust and who was the swing producer or the central banker of oil market is Saudi Arabia. So I wouldn't, when it comes to the spare capacity, of course, we look at the group as a whole, but we look at the country that matters the most in terms of adjusting their productions quickly upward or downward. And the Saudis have proven to the world that they can do that pretty easily, unlike others. Now, of course, Russia is an important producer within OPEC Plus. It's actually almost on par with Saudi Arabia. And it has a strong influence over the group's decision and as well oil markets. However, if you plot over the last few years, Russian production versus Saudi production, you can barely see any substantial movements in Russian production, unlike the Saudis when they, deepen their cuts, and then when they put more in the market, etc. So you can really tell where that spare capacity is an ability to manage the supply in OPEC. So I wouldn't worry too much about the other countries within OPEC. I'll keep my eyes on mainly what the Saudis and the other major producers within OPEC Plus with the spare capacity can do. And in that respect, I think there is plentiful supplies around, whether idle or in the market. And that does not show today because of short-term hurricane seasons in the US, among other, news. It's a bit positive here, but negative there. But I don't think we should be too worried about markets being too tight today.
Well, let's take that forward, Ole, and we'll get you in on that. The survey question, give everybody in the room a view on that going forward. In Q4, Brent crude oil will break out of the $65, $75 barrel range of Q3 and move into the $75 to $85 barrel range. That is just where it sits this morning, above 75. Do you agree with that thesis or disagree that we will move out of the range we've been in Q3 and move higher? And I suppose it depends on your view of how tight this market really is. Ole, you wanted to pick up on that.
Yeah, I would like to add the option of 75, 85. 70 to 80. Then I probably would have agreed. I think we are still a little bit too early in terms of seeing prices get to those levels. But the OPEC Plus is obviously is very, very important. And as also Carol mentioned if we do get we do have these laggards right now, Nigeria and Angola. They're probably producing around 400,000, almost below below their target. So if we continue to see these problems, then we will ultimately have to change the allocation within the group, favoring more Saudi Arabia to pick up those additional barrels that Nigeria and Angola probably are struggling to increase by. So that's an interesting one to follow over the coming meetings. But right now they are as collectively as a group producing less than they actually can. So that will provide some underlying support. But I think as we started the program, we've been ebbing and flowing, focusing shifting between demand and supply. Right now it's tight supply, but the demand story has probably not gone away just yet. We are not entirely out of the woods. So I think that it's probably just still too early to see much higher price at this stage.
So you would need to see in Q4 real tangible demand recovery in order to support 75 to 85. I mean, OPEC is predicting that 6 million barrel a day average on the year requires a fairly robust Q4.
It will require a very robust Q4, and we're probably going to see most of that being fulfilled. But at the same time, supply disruptions are in nature relatively short-lived, so we will get on the other side of that. And if the result of this supply disruption is based that we suddenly have a shift, $5-10 shift in the oil price, what would that do to shale oil production next year? So I think that's worth keeping in mind as well.
Dr. André, what are the question marks regarding that quota, OPEC Plus meeting its own target? Is Russia, the 11.5 from next May, but at the moment still struggling to meet the existing quota?
Yeah, but that's basically has been for ages. Yeah, so basically this kind of like flexibility that Russian production was kept at the level of flexibility that has been actually from the very beginning of the OPEC Plus agreement. And here we actually the other way around from the gas supplies, right? In the gas supplies, what we actually see is that Gazprom does not add incremental flows to the spot markets. Yeah? So it fulfills long-term contracts, but it doesn't add much to the spot. Here we have the other way around. In oil, we have a number of producers, and there are quotas, but there is an excess of production compared to the quotas, and I guess everybody closes eyes about it. So basically, Russian flows have been always higher than the quota allocated. Having said that, and coming back actually to our earlier point about European situation, what is important to bear in mind that competition is not only about intra-fuel competition, like for example between Gazprom and the American LNG, but also about inter-fuel competition. Gas versus coal versus renewables and so on. And that's exactly where the European markets failed, by having closed a number of capacity for coal generation and for nuclear power, which basically leads to restricting inter-fuel competition in the power sector, which amplifies the difficulty for inter-fuel competition by the ETS price, and then it gives the whole way to any supplier to influence the market. In addition to that, there is an uncertainty, regulatory uncertainty for newcomers. Like, for example, why don't we see under such a price new liquefaction trains coming up or new even production coming up? It's because everybody is looking what's going to happen with the methane regulations.
And the carbon price, will it come from COP26? Let's give Carol the last word today. It's the only right thing to do at the end of a week. Let's get the survey result first and give her a pitch on that and see what it says. Survey result is indicating that there's general agreement, I think, with the, where's the agreement? Yeah, agreement that we will break out of the $65, $75 range. Your thoughts, Carol, on that and the outlook? Obviously, we're coming to the end of the Middle East week now. Today, oil prices firmly above 75. Will they hold into the weekend? Your thoughts?
Yeah, into the weekend, I don't expect many surprises to reverse what we are seeing now with oil prices too short. But next week, I think will be more interesting because I think we should expect to see more economic data emerging. And that is always something that the market is waiting for. And it has its repercussions also on oil market. Oh, now I can see the survey results. So 66% agree that the oil price is going to be into the 75, 85 range. But I would say that if you'd said 70 to 80, maybe it would have been more reasonable. So really nothing much no surprises this week. The hurricane is still hitting the US and creating, in my view, exaggerated supply fears, because it's not like we're talking about the days that we had in the early 2000s where the supplies were pretty constrained and not being able to catch up with demand. I have to add on what Ole said, that's definitely we should bring in the demand into the picture, though, and I could see one of the panelists asked about the differences in demand forecast, and I was amazing by the IEA switch in mood after they were very gloomy in their last few months, the oil market report forecast for oil demand. They have a much more positive outlook for oil demand, at least for October. Whether that will hold or not, I think it depends on various variants. I mentioned earlier the news coming out of China. The COVID news are still with us, so I am really surprised by the number of in-person events mushrooming. Only a few days ago, I discovered by coincidence that I was expected in Angola, and I thought it was a virtual event, but I had to decline because of the—
Your hologram will go in your place.
I can send you, if you want. No, but so lots of moving parts, and I think that we will continue in this, as you said, Sean, earlier, half full, half empty, until something takes the upper hand and we are set on a new track.
Well, it feels like we're in half full mode, even with the knockout in Ida in the Gulf of Mexico. It obviously is the wind in the current sales, but nonetheless, there's always wind from somewhere. Next week, big week, I think. German elections, Canadian elections, Fed meeting, even the Gas Tech meeting conference in Dubai in itself is nearly an event all of its own. Not because Dr. Carroll is speaking there, that in itself is big news, but ultimately, will this be the return of the gathering of the industry? Will people show up? Will it be a success? I surely hope it will. But until then, next week, Ole, thank you so much for joining us from Copenhagen, from Denmark, Carol from Germany, Andre from Estonia. Definitely a European morning. Let's hope the German election delivers a very positive outcome for all Europeans. All the best. Have a great weekend. Thank you.
Thank you. Bye-bye.